stocks rallying in yesterday's session, hitting a 3-day winning streak. Anticipation for the annual Santa Claus rally is building. It kicks off tomorrow, Christmas Eve. The AI data center infrastructure trade has rebounded, with names like Irene and Oracle regaining some momentum as of late. Nvidia also finally bouncing off 3-month lows, but the real story here continues to be commodities. Gold and silver both hitting new records yesterday, while platinum rose above the $2,000 level for the first time since 2008. And you can't forget copper hitting over $12,000 per metric ton for the first time ever on the London Metal Exchange. Joining me now, Michael Reinking, senior market strategist here at the New York Stock Exchange. My man, good morning. What a festive week it is. Thanks for joining us.
Yeah, good morning. Thanks for having me. Yeah, it's the holiday cheer is in the air, but it is a little bit quieter down here on the floor this morning.
It is, but I like it, though. So great to have you here on the show. Can I get your take here? First and foremost, higher than expected GDP print. I was taking a look at CME Group for what that means for interest rate cuts.
Yep.
We're still baking in two cuts for next year.
So, I mean, look, the numbers came in very strong. You're kind of well ahead of estimates, 4.3% up from 3.8% in Q2. It's not typical that, as we're approaching the end of the year, that we're finally starting to see, right, that the Q3 numbers, right, and that, delayed by the government, kind of shutdown. But if you look kind of beneath the surface, the consumption numbers were very strong, coming at 3.5%, well ahead of 2.7% estimates, right? So we'll have to see now, kind of, does that mean there was a little bit of a pull forward in terms of, kind of the holiday spending, or, if we see just a continuation of that strength? And then within the data, we also saw the prices components came in a little bit hot. So in response, we saw Treasury yields move up kind of 2 to 3 basis points across the curve. But as you pointed out, right, there's no real shift in terms of, kind of where expectations for monetary policy kind of are moving.
Kind of a wonky year for GDP prints, right? You got that pull forward phenomenon for the first quarter of the year and the expectation of tariff pricing pressures. What does that tell you? I mean, I feel like we've lived already through a Trump administration to have some sense of what tariff uncertainty looks like, but we're still seeing a lot of these kind of skewed numbers for GDP.
Yeah, and we're seeing a lot of the data has been sloppy, so you're kind of waiting to see where you need to see kind of a couple of prints, kind of in terms of the CPI reports and the labor market data, where you're going to want to see some of that, just normalization before you can really make, kind of any policy decisions from a Fed perspective. There is this expectation heading into next year, right, that we are going to start to see, some of the positive impacts from the One Big Beautiful Bill, kind of in terms of consumer spending, right, and also kind of on the capital spending side of things, kind of with the tax incentives that are in there, right. So that potentially can, kind of help GDP continue to grow, kind of at an above, kind of trend clip, kind of heading into next year.
Yeah, we also got this chatter of additional $2,000, some type of tariff-related dividend stimulus payments, which you'd have to imagine. You get a few voices in the corridors of Wall Street would say maybe a little bit of upward pressure on inflationary spending if you continue to give consumers too much money, maybe arguably to spend. Since it's near the end of the year, I'm going to go off script for a bit. Strongest performing sectors in the S&P in 2025. Tech #1, no big surprise. Then you got telecom, communication services #2, industrials, and financials. #5 is healthcare. So you see some of those defensive trades are right about where the S&P has performed. Any big surprises to how things have gone?
Yeah, so I mean, the communication services, right, that's just an extension of the mega cap tech strength. And then if you look at the industrials, right, a lot of that is also kind of related to that AI trade. Now, as you pointed out, healthcare, which was a big underperformer throughout much of the year, kind of has made up a lot of ground, kind of over the last, kind of month or two, and we are starting to see, kind of more cyclical areas of the market begin to outperform, right, as there is this expectation for kind of, an uptick in, kind of economic activity as we head into next year. So that's kind of the big question, kind of for 2026 is, does it continue to be this AI trade that continues to drive markets, or do we finally see, that broadening of the rally, and does that kind of stick throughout the year?
Real estate, staples, energy, and materials are the weakest performing sectors here in 2025. Tomorrow kicks off. I mean, we love indicators. We love seasonality. We'll go back to Yale Hirsch, 1972, the original Stock Traders Almanac, saying, hold on, we got the Santa Claus rally phenomenon. final 5 trading days of a calendar year, the first 2 of the new year, the Santa Claus rally. What are you looking for starting tomorrow?
Yeah, so historically, right, that's been an indicator in terms of how markets kind of perform in the following year. It tends to be kind of a pretty good, back to 1950, you look at return profile over that 7-day window of a little over 1%. That being said, right, it's part of a bigger indicator, right? It's the January trifecta, right? So you have the Santa Claus rally, which is the final 5 days, and the first 2 days. Then you look at the 5-day indicator, the first 5 days, and then the January barometer. Now, over the last 2 years, right, the Santa Claus rally actually, during that time period, markets ended lower, right, and we had two pretty stellar years of performance, right. So you can't just look at any of these things, kind of on its own, right? You have to kind of put everything together. Now, last year, the first 5 and the January indicator were both up, right? So, we'll have to kind of see how that first month of the year, kind of starts to, plays out.
I got less than 30 seconds. Big catalysts on your radar as we head into the new year.
Yeah, I mean, we're still waiting for the Supreme Court decision on tariffs, right? And just kind of on another kind of rotational idea, right? That could help kind of the retail sector, which has been an underperforming sector, right? So if they kind of walk back tariffs, right, you would see kind of kind of some relief, kind of for retailers. So that could help to drive a little bit more rotation elsewhere within the market.
The great Michael Reinking, senior market strategist at the New York Stock Exchange. I mean it when I say good to see you, Michael.
Yeah,
Thank you for being here.
Good to see you, and see you guys in 2026.
There you go. All the best for the holidays.